to watch this. Give me a second. I'm just making sure everything works because I do this totally on my own, and I need to at some point hire somebody to do this stuff to make me look like I'm not doing everything. This should be a really, really good conversation, a real joy for me. I had somebody DM me a couple months ago. I'm trying to find that person, so if you are watching, I apologize for not DMing you and letting you know this conversation is happening. But I had somebody DM me saying, "You got to get this professor on your podcast, Leland Live. You got to get this guy's Professor Genn Okun." And the name sounded really familiar. And it turns out he was my professor at NYU. So this is kind of a cool little bit of a reunion. I think this will be enjoyable for everybody here. Those that are watching this live, please like, repost, comment, all that stuff. If you want to ask a question during the chat, I'm more than happy to bring it up as we're live. So feel free to engage on the YouTube side as you're watching this. And as always, this will be an edited podcast under Lead Lag Live, over 1 million downloads over the last year and a half, 2 years. With all that said, my name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the Rough Hour is the man, the myth, the man who taught me a couple of things from NYU, Mr. Professor Genn Okun. Or should I call you Professor? I feel like I should still call you Professor.
After whatever you like, Michael. You're an alumni now, so it's
right. Right. So that means you're going to ask me for money at the end of this conversation.
I never do that.
So, Professor Okun, introduce yourself to the audience for those watching. Who are you? What's your background? How'd you get involved as a professor? What are you doing currently?
I'm a professor of management, entrepreneurship, and finance at NYU Stern School of Business. I focus on entrepreneurial finance, venture capital, and private equity investing, and on startup management and growth management subjects. Basically, everywhere where we put capital or talent and time in a position of highest possible risk with the hope of justifiable returns.
Let's get right into that, because I'm going to assume it's a little more nuanced and harder to do just that in a higher interest rate environment. When I graduated many, many years ago, you did not have zero interest rate policy. This was before the GFC. But a lot's happened in terms of the cost of capital and then the justifiable rates of return that different small businesses can try and target. Talk about just sort of the evolution of the cost of capital when it comes to entrepreneurialism, when it comes to trying to build a small business into something that's larger.
We have had a persistent long-term problem, a scarcity of startup capital. Despite all of the publicity around crowdfunding, angel investing, early stage investments by some venture capitalists, we never have enough startup capital, and startups, of course, cannot access the conventional debt markets. And so it's true. It's one of the few bromides of entrepreneurship that's actually true. The first round of capital is the most difficult to raise simply by virtue of that scarcity. We have come through a period of abnormally large amounts of startup capital, still scarce, but not as scarce, by virtue of unusually low interest rates during the COVID period. That financial repression designed to prevent a depression also made capital much more aggressive because fixed income rates of return were driven to unappealing interest rate levels, and that increased the flow of capital into every equity asset class, including venture capital funds and private equity funds. Now that we have reestablished higher interest rates, we're seeing the deceleration of capital flows both into venture capital and private equity funds, but we're also seeing a collapse in the exits for portfolio companies, for private equity and venture capital firms to sell their portfolio companies or taking them public. We've had a very small number of transactions relative to recent history. That has the effect of both damaging the returns to the existing funds but also reducing the available institutional capital for new funds. A lot of institutions actually recycle the capital distributions from their existing funds into commitments into new funds. And so this suggests that, barring a a 400 basis point reduction in interest rates, which I'm not expecting, I expect we're going to see a reduction in the risk capital that's available, not only for early stage ventures, but also for the more the later stage investments in mature companies that private equity firms make.
Is it scarcity, or is it concentration in specific sectors? In other words, it's just getting funneled more towards tech. I mean, I remember whatever 2.5, 3 years ago, all the news stories were around all this VC money and private equity money going into anything blockchain, anything crypto, and it seemed like everything else was dry around that. How much of it is scarcity versus just there are not that many? There's not much of a desire to go outside of the hot sector of the moment.
What we're experiencing is both a contraction in the capital being committed to new funds, and we're also seeing a concentration of that capital in a smaller number of funds. This is the traditional flight to quality phenomenon that occurs in a contraction phase for private risk capital. Some institutions will simply eliminate or reduce their asset allocations. Others will maintain an asset allocation, but make a smaller number of larger commitments. So it's the strong get stronger, which is why you'll see periodically in the Wall Street Journal the big name venture capital and private equity asset management firms, the Apollos, the Carlyles. They can raise substantial sized funds, maybe not as large as they would like, but they're still able to raise large funds. But we've had an absolute retreat away from first time venture and private equity funds, and more boutique firms are also struggling to either raise a follow-on fund, a successor fund, or raise a fund near their target size. In this flight to quality, having a big name is not enough. Tiger Global had to delay its closing of its 16th venture capital fund, and they had to close it at 1/3 of the original target size. And so we are seeing, fairly significant reduction here.
Okay, you use that term, the strong get stronger. The Pareto principle gets even more Pareto principled, if that's so to speak. The 80-20 becomes even more concentrated. I wonder if there's any way that can reverse, because when I hear that, if I'm thinking from the standpoint of my younger self, being an entrepreneur, if I have the sense that the strong get stronger, that the capital is just being funneled, to these big players, it's kind of demotivating, right? To be an entrepreneur when it just seems like you're not going to be able to get ahead unless you're already ahead.
That's why you see a focus on a small number of investment themes. The investors with capital, the general partners of these funds, are the only investment decision makers with capital to invest. They're going to be very sensitive to any preferences of their limited partners. So they won't wander outside of an industry that excites their LPs. And so this is terribly disheartening for founders. What causes this to change is predictable. The timing over which it changes is completely unpredictable. And so we are early in a portfolio asset value write down and write off cycle in venture funds. Private equity really hasn't started yet. And so what is typically the case, we will go through not a number of quarters, but a number of years, perhaps as many as 4 to 6 years, when capital flows will remain diminished into new funds. Write downs and write offs in existing funds will be taken. At some point, they become inevitable because funds reach the date at which they expire and have to liquidate. If our general partners can't sell these companies, can't take them public, when we get to the end, everything will get marked to market. And we're operating in an environment now where, with the diminished supply of credit and the much more conservative valuation discipline in the market, in private equity, for example, where companies have frequently been financed on the debt side at the 3 to 4 year time period, now that the average holding period in private equity funds is back to a 5 year hold on a portfolio company. 2.5 years ago, it was 2 years. So that 3 to 4 year term that was sought on debt made sense. But in our current environment, which is much more typical on a long-term basis, we have general partners trying to manage private portfolio companies that they never intended to have to refinance. They invested under the presumption they would sell or take them public before senior and subordinated debt came due. So unfortunately, private equity is getting hit on both sides, not only facing downright depressing prospects in the exit market, but they're facing a refinancing environment very much like a commercial real estate investor. We took out a big mortgage. It was aggressively underwritten. Now it comes due. We can't refinance it in total. So if we're going to refinance it on these tougher terms at the higher interest rate environment with the depressed asset values, we have to contribute additional equity at the closing to avoid defaulting on the loan. This is something private equity has not experienced since the early 1990s. This has happened before, although there are very few people around who had a chance to observe it. I was one of those people. And so this is when general partners, in an absolute panic, if they can't refinance it, they can't, they're forced in a position of default or reinvestment. Reinvestment may be impossible. A fund may be out of its investment period. In other words, it may no longer have access to capital. Even if it has access to capital, limited partners may not want more capital being invested in devalued portfolio companies. They may view it as investing good money after bad. And so we're likely to see, although it won't be coordinated, it'll be on a fund by fund, portfolio company by portfolio company basis, we will start to see loss of value.
It's actually, I'm glad you mentioned that point about coordinated, because it doesn't sound to me like it's an event. It's a gradual rolling write-off that just creates even further unevenness in the stop and starting of the economy.
I would like to think that I'm original, Michael, but if you have a good memory, you may recall that I previously have described this as death by 1,000 cuts. And so these are prolonged periods of poor performance when we're effectively devaluing and disposing, because we can't, with a single unified solution, dispose of the assets. So in the global financial crisis in 2008, where we were infected with an enormous mass of low quality defaulted subprime mortgages, well, the subprime mortgages, for the most part, are a homogeneous asset base. you can devise a single solution and just devalue and dispose relatively quickly, and then address the capital inadequacies that result at institutions that acted as investor or lender in those circumstances. What'll be much more challenging this time, we have a set of problems in private equity that will relate back to a series of lenders. In venture capital, we will have a series of problems related to certain leasing companies that provide financing so venture-backed companies can lease equipment. But it's to a significant dollar amount. Similarly, we have this kind of problem as well in the commercial office real estate market, where we have, what's estimated to be what could be as much as $1 trillion worth of commercial office mortgages coming due. And if you combine that with the CMBS exposure of $1.5 trillion, this is a problem geographic market by geographic market, asset by asset. But we've already started this cycle in San Francisco. The institutional owners of the largest shopping center in downtown San Francisco defaulted and gave the title back to the lender. We've seen it with a number of office buildings in Los Angeles, again, where high quality institutional owners and institutional asset managers have made the decision that a further investment of equity capital is not justified based on the future value of these buildings. And so the problem in the office space market is that it's fundamentally overbuilt across most major downtown central business districts in the country. And there is no one size fits all remedy. So, here in New York City, for example, in Manhattan, if you have a bad downtown office building that was built prior to 1950, you can convert that into multifamily dwelling, rental apartments or condos. That model works. It worked after 9/11. It was with the first wave of those conversions. But if you own a B grade, a large footprint, modern office building, big square floor plates that was built in the 1970s, and you don't have tenants, there really can't use that solution. You can't break it up into apartments because most of the apartments wouldn't have windows. And so that becomes the trouble with this kind of a correction in private assets. If you worry about the economy, the only thing you worry about is, will there be a concentration of bad assets in the hands of capital providers in one region of the United States? So that's what the Federal Reserve is worried about. They're not worried about, nationwide catastrophe, and neither am I. But if we get a concentration of problem assets in any region of the United States, the regions of the US are quite susceptible, because in many regions in the United States, the majority of business lending is handled by 2, 3, or 4 regional banks. And so that's where there could actually be damage done to regional economic growth, which of course would affect GDP.
So that actually goes perfectly to that other question I wanted to ask, which is, at what point is idiosyncratic systemic, right? So it is the concentration. Okay, no disagreements, but something happens that causes that, right? I mean, presumably.
Well, the cause of the inflated valuations was the financial repression during COVID, and so we were witnessing excess risk taking on the investing side. You can't just blame the investors. After all, you can't finance a big office building without some lead tenants. And the lead tenants we can thank are all the big tech companies, which up through 2018, 2019, were growing so rapidly that it was standard practice for them to sign leases in buildings that had not yet been built for space they didn't need yet, assuming that by the time the building was ready for occupancy, they would have headcount requiring that space. That entire cycle of rapid growth, of course, has collapsed. And so now we're working through the unwinding of all of that, which will be problematic and time consuming. That's the bad part. If you're a founder, if you're an investor, you don't want to invest in markets that are dealing with an overhang of problem assets, not just tying up capital, but tying up investor attention. So when an investor is beleaguered by problem assets they have to work their way out of, they're not making a lot of new investments. They're using their time to try to engage in successful recoveries. And so this has a set of effects. Certainly, none of them are good for the startup economy.
All this eventually will create opportunities, obviously. I mean, I always go back to, if you're a real investor, you want dislocations.
I am, if you've been reading The Rabid Capitalist, I love this. This is my favorite environment because it creates bargain assets. We have to be stock pickers, whether we're investing in publicly traded securities or buying private assets. You can't buy an entire basket of assets. You have to be able to select the ones that are irrationally discounted to future fair market value, where you understand how that fair market value can be created. And that's where there are bargains to be had. In 1990, when we were dealing with the S&L crisis, banks, smaller banks, savings and loans, had made lots of ultra aggressive loans. When the capital flows seized up, there were great individual assets to buy at discounts that are hard to believe. At that point in time, I was an investment manager of the IBM Retirement Fund, which at the time was one of the 10 largest pension funds in America. And we actually bought a brand new office building as an investment in the best part of downtown Dallas, Texas. The actual cost of the building was $250 million. The building was empty. It didn't have a single tenant. We bought that building for $25 million. Understanding that over time, we would get at least, and that the cash flows, even in a depressed market environment, would create attractive cash on cash returns.
Speaking of irrational discounts, what has a larger irrational discount, technology or energy?
Energy.
Let's talk about that.
Energy is and has been dealing with negative sentiment by virtue of green enthusiasm, green energy enthusiasm, now for well over a decade. I've previously posted graphs showing the valuation of the green energy index to the oil and gas index, and one looks like it's going out of business, that's oil and gas. The other looks like it's the future, increasing in valuation multiple rapidly, that's green. Of course, in truth, we don't have green energy solutions that today could replace oil and gas. None of our alternative energy solutions can actually supply the energy necessary on a cost-effective basis. And so when politicians say, well, we'll go green by 2030 or we'll eliminate gas-powered cars by 2032, that's great as a political stump speech, but it's absolutely an impossibility. So much so that in our current green investment cycle, we've been having these green investment cycles since the 1960s. Nothing here is new. We now are at the phase when green valuations collapse because there's recognition of the fundamental inferiority of the current green solutions. And that's when the government removes the subsidies and the tax incentives that were designed to sponsor the development of these green alternative energies. So we've seen that now in solar. The solar installation credits have been drastically reduced and in some states completely eliminated. Even in California, the most green-seeking state in the nation, even they have cut their subsidies. This will ultimately, cause firms that survive to trade at very low valuation multiples. We can't go green until we innovate solutions to very difficult problems. Problems I describe as stubborn technology problems. Despite all of our efforts, manpower, and capital invested, we haven't been able to successfully innovate. At the linchpin of a successful green transition, we need to invent batteries for storing energy that do not exist yet. We're not able to store wind generated power, solar generated power on a cost-effective, efficient basis, which is why the electric grid, the utilities, by regulation, have to take wind and solar generated power the moment it's created. They have to buy it at an agreed upon contract price, in many instances far above market, because that energy can't be stored in any kind of a cost-effective manner. And so that's the subsidy from the utilities to these generators that has allowed solar and wind to grow, but that's not a reliable solution. It gets very, very expensive, which is why now half the wind power installations in the United States are being taken offline. They can't make money at the subsidy they were given. The government won't give them a larger subsidy. And so we're just in this infancy, this early stage, and we simply can't transition any more quickly than innovation allows us to. But unfortunately, these are legitimately difficult innovation problems. As it relates to the battery, we're currently in electric vehicles using lithium-ion batteries, the same batteries that are in your laptop computer, your tablet computer. And these batteries are not appropriate for the purpose, which is why an electric vehicle, the entire base of the car, from hood to trunk, side to side, is an array of lithium batteries. It adds 30 to 35% to the weight of the car. And these batteries hold an unpredictable charge, the same way that your iPhone holds an unpredictable charge over time. It's not Apple nefariously tweaking their operating system so that it drains your battery so you buy a new iPhone. It's just the inherent instability of lithium-ion batteries. They're not chemically stable. They don't hold a constant charge. And one of the reasons why in the US, no one but early adopters have purchased electric vehicles because of their limited utility outside of Sunbelt states with temperate climates and relatively constant humidity. That's where an electric vehicle can get close to delivering the drivable range in miles for which it's rated. Take that car, stick it in Connecticut, you'll get a third to 40% of that drivable range before you deplete the battery. And so, again, these are just, we're trying to use technologies that are compromises. They're the best that exist, but they're really not fit for purpose. And that's fundamentally the problem that Tesla will be wrestling with for years, and why I would expect Tesla to come under tremendous pressure, not only in terms of quarterly financials, but more importantly, in cars delivered, such that their overall market cap is likely to fall quite drastically. It won't be ultimately valued like a tech company. It'll be valued like a car company. And on that basis, it's barely worth $75 a share today.
And that's probably why Musk recently is saying to Buffett he should use his cash to buy Tesla,
Yes.
because Musk is not naive. He must be aware of
No.
this dynamic. I am curious though, but because it seems to me that the only real solution answer is nuclear, is uranium, right? And I get it. There's still concerns around that, but the reality is, if you're going to power AI, if you're going to power EVs, there's nothing else that you have really to choose from except uranium and nuclear.
Yes, nuclear is ironically, it's the only green energy source that works economically and works predictably, but politically is untenable as a solution in the United States. We'll bring one nuclear reactor online in the next 24 months. It has spent the last 12 years in the federal permitting process. And so we have created formidable obstacles to nuclear. But if you really set out as our top objective as a nation to eliminate fossil fuels, nuclear power is the only way to power the electric grid, and high-speed rail systems, high-speed regional rail systems is the only transportation solution that is green, that has a demonstrated track record of success wherever it's been implemented around the world.
So if you're going to be investing in these from a very long-term perspective, do you go about it from an average, meaning, find a fund that is focused on oil, gas, nuclear? Do you get a little more creative and do individual stock picking? I mean, put the academic hat on, right? Stock picking really doesn't work. It's all about asset allocation. It's hard to find the winners in advance, right? .com was a thing, but a lot of companies didn't survive. How do you think about that? Because there's an argument to go for the average, but of course, if you go for the average, you get average returns.
Yeah, the problem with passive investing, index-based investing in emerging spaces is that the index creator is doing the stock picking, and so you're subject to the same set of risks. As a result, the only way I view playing the green transition is to buy the global mining companies that are publicly traded, that have very high dividend yields. Rio Tinto, BHP, Vale. If you own those three, you have ultimately a diversified portfolio of all of the major minerals that will be necessary for any green power solution that gets implemented.
I was smiling when you were saying that because I was not expecting the first thing to come out of a professor's mouth. The reason passive doesn't work, right? Because
Yes.
that's always the thing, right? It's like, and there's a lot of academic research. It's very valid that it doesn't work. But now that I've been in the industry from the standpoint of seeing what other index providers, other ETF issuers, what they do, you're exactly right. Right? It's they are the ones stock picking, and you're buying their products.
The good news is for the average investor, they should be passive, but they shouldn't be investing based on a thematic approach. They shouldn't be trying to create a green portfolio using index funds. They should just be indexing the broad market. Those index funds work very well. S&P 500, Russell 2000, those are stable product offerings of the investment management industry. They're inexpensive to own, and they track their market index relatively closely. But that merely creates a plain vanilla equity allocation. The moment, as your question suggests, Michael, that you would want to be investing in themes of interest, the green transition being one, now the problem is we don't have stable index for that industry. So it's just our passive index creator acting as stock picker. If they pick the wrong companies or in the wrong overall allocation within the index to each other, that will leave us with unsatisfactory returns.
It sounds to me like the equity side makes more sense than investing in the debt side, right? Unless you have a real dislocation. But I mean, these companies have such tremendous cash flow; it's hard to imagine, the bonds kind of really trading off. Going back to the cost of capital and sort of the maturity wall dynamic, is it fair to say that the energy sector is not going to be as dependent on the cost of capital as it used to be? I mean, there's this argument out there that there's been tremendous underinvestment for a long time because of everything you just said, the green transition. They've been shunned away from investor capital, but they've survived really strongly. They've got high free cash flow. Sounds like they're pretty much isolated from whatever happens to interest rates.
The oil and gas majors, Exxon, Chevron, and 6 or 8 other domestic companies, and 3 or 4 European companies, BP, Total, Shell, among others. Those are companies that have great access to capital, tremendous cash flows, and they've adopted a balanced corporate finance strategy. This started 3 or 4 years ago, as opposed to being focused almost exclusively on expanding reserves and deploying most of their capital toward exploration, development, and production. About 3 years ago or so, they shifted to a balanced approach where they're still adding reserves, but in a shareholder-friendly way, meaning directing cash flow to attractive dividend yields and share buybacks. That, combined with the consolidation of domestic oil reserves, oil and gas reserves, creates a very attractive commodity price environment for our US producers. Within the next 6 to 12 months, over half of all US oil and gas reserves will be owned or controlled by 10 US companies. And there's nothing better than an oligopolistic set of conditions in an industry if you're a shareholder.
I've interviewed different people talking about competition. Since you mentioned oligopoly, Matt Stoller comes to mind. And I brought up this point that it seems like every industry is increasingly becoming an oligopoly. This goes back to the big get bigger concept. Um, is that fate for the economy? I mean, can we ever get back to sort of a more even, more fragmented state for the system, or is everything going to ultimately be too big to fail across every single major sector of the economy?
We tend to go through periods of time where concentration is the norm, and they tend to be relatively long time periods. But then, by virtue of innovation and fundamental change in industries, fragmentation tends to then get reintroduced again. Where we are in that cycle depends upon the industry and depends upon who you ask. For our technology industries, they tend to operate on a 50 to 60 year cycle where you get fragmentation in the first 20 years, new entrants championing new technologies, take early share. Think Amazon 25 years ago, Google, Facebook. But after that initial 15 to 20 year period in that innovation cycle, the land grab, major market share in major markets has been captured. And then for the next 30 or 40 years, those entrants become the dominant players and consolidate until they are either displaced or destabilized by new innovation. This is, of course, what happened in the television equipment industry. RCA and a small number of companies held concentrated market share in the vacuum tube era of television set technology. But when solid state technology was created, that introduced fragmentation, and lots of other companies were able to capture attractive market share. And of course, RCA, the leader during the vacuum tube era, became the technology loser during the period of that new innovation with solid state technology. That tends to be what we see over time periods that are hard to accurately predict. The old line is that technology leaders ultimately become technology losers.
Just for the sake of
Now, an
being
industry that actually resists that is the oil and gas industry, because the oil and gas industry innovates technologically, but they never sell their technology. They do their best to keep it a secret, how they squeeze additional volumes of oil out of the ground. And that's been the history of success in the oil and gas industry for the last 150 years. They just innovate new drilling and recovery techniques so that more and more oil previously judged as not feasible economically becomes economically feasible. Minerals, we will see in the mining space, we will see a similar kind of an approach. And that's where the big can continue to get bigger longer term, because they are the innovators. And the scale required to try to enter and innovate is prohibitive.
so where I was going to go with this is just to play devil's advocate. The skeptical person would say, yeah, but lobbyists and Citizens United and all this money emboldens the current position of the existing companies. So it's not so much about innovation; it's about political policy and how much you can influence decision makers. Is there some truth to that idea that maybe that cycle is not like it used to be because of the intersection of corporate money with politics giving an edge to these companies?
I think what we've seen is a leveling of that playing field. So the green industries have very effective lobbyists. They've gotten subsidies out of Washington that I would never have imagined. And yet they are the minority market share holders, but they have tremendous political influence. So I think that is fairly widespread today. So that no one group of industry participants would necessarily have an advantage through lobbying.
No, that's a valid counter. One thing we didn't touch on, which I am curious about just for the last few minutes here, is you did want to talk about BDCs, business development companies, private credit. I have not tracked the private credit side that much. A lot of people seem to be of the mindset that one of the reasons why credit spreads have been so tight in the public debt markets, especially around junk debt relative to AAA, is because of private credit strength. I'm not quite sure I understand that linkage. But maybe just to wrap up, just explain what private credit from the BDC side is and why it matters and why it may be a complicating factor as far as how to think about the cycle we're in.
In the alternative investment world, private credit is really the only bright spot. And this is where non-bank lenders are providing the debt that companies need, that companies that want to do transactions need. And today, it's estimated by Bloomberg that 25% of all of the private credit capital is held by what are called business development companies, BDCs. These are registered investment companies that operate as closed-end funds. There are 40 some odd of these that trade in the public market. And we're in this unusual time where the retail investor, the individual investor, has equal access to an alternative investment asset class if they want it, simply by investing in publicly traded BDCs. At its highest level of abstraction, a business development company is an unregulated bank that does not have depositors. They make loans, they have offices, they originate loans, they do underwriting, they do servicing. Their source of capital from the public and private capital markets. The BDCs issue debt, raise equity, and they're playing the game of traditional spread lending. Main Street Capital, one of the very, very well-managed BDCs that's publicly traded, that for the last 10 years has delivered a 15% cash-on-cash return, just priced a very large unsecured debt offering at less than 6%. They will loan, using that pool of debt capital, they will make loans at between 500 and 600 basis points over their cost of funds. And the vast majority of the loans they make will be floating rate loans. So they're transferring the interest rate risk onto the borrower. And so these are, as investments, they're only as attractive as the quality of the management team within the BDC. And there's quite varied performance, but the top tier BDCs, the Rabbit Capitalist has recommended 6 or 7 of them, have generated returns, total returns in the last 9 months at a low of 10 or 12% and a high of 26 or 28%. So this becomes the replacement capital source for banks that are operating on a much more conservative basis today, other unregulated lenders that, by virtue of their own portfolio problems, are not focused on lending. They're focused on restructuring assets in their existing portfolio. And of course, because private equity is in a problematic position, they're not as active as lenders either. They're actually more likely to be borrowers today. It's hard for me to believe that private credit could have that degree of influence over spreads, given that there's about $2 trillion worth of private credit capital floating around. And of course, the size of the debt capital markets is much, much larger. I think on any one individual loan opportunity, it's possible that private credit could introduce the degree of competition to win that loan that would narrow spreads, but not, I wouldn't think asset class wide.
Yeah, I need to look at that further because a lot of people made that argument. I can't quite find the connection by any means, unless it has to do with the comps, right? Kind of law of one price type of thing. That's the closest thing I can think of, but I don't know. Professor Okun, for those who want to track more of your thoughts, more of your work, who cannot go to NYU, where would you point them to?
You can find me at therabidcapitalist.com, which is my blog and website, and that's the source of my newsletter.
And also on X, right? On your handle there, which you need to get
X,
more active
on Facebook. Yeah, I know, I'm trying.
Well, I certainly appreciate those that watch this. Hopefully you enjoyed the conversation. For me, it was a blast from the past because I had, as I mentioned, Professor Okun was one of my teachers when I went to NYU Stern School of Business. So certainly enjoyed learning again from the professor. So thank everybody for joining, and stay tuned for the next episode. If you have any comments, like all that stuff, please engage with this video, and we'll see you next time. Thank you, Professor Okun.